All right. Good morning, everyone. Welcome. Cynthia, Chelsea, and myself are excited to have you here for our 2024 election year market and economic perspectives. So we have a couple legal slides we have to kind of go through because everything we're sharing with you is our educational format only, and any takeaways you need to share with your trusted advisor. So with that, I think I drew the short straw and got the lead with the election and markets, where Chelsea will discuss the economy and labor markets, and Cynthia will bring home the presentation with inflation, talk about the Federal Reserve and rate cuts, and possible portfolio implications and repositioning. So getting to the first slide, the election and markets, 4 lessons from the past. So our U.S. political landscape has taken several twists this summer. I don't think anyone saw, at least at the beginning of the year, saw President Biden stepping away to allow Kamala Harris to step in as a Democratic candidate. And we'll probably have a few more twists and turns before the election here in a few weeks. But given our country's highly polarized political environment and the disparity in policy and principles, many investors may wonder whether the election's outcome will affect the financial markets. And given the 24/7 news that we receive and all the streaming, we're in the front row seats whether we want to be or not. So investors wonder whether they should alter their investment strategy accordingly. So I always like to reference a famous Mark Twain quote: "History never repeats itself, but it does often rhyme." So I'm going to share some history sound bites that we've experienced in the past, and really kind of, I think, shows that the last 8 years is not as unique as we once might think. So going back in history, the election of 1800 between Thomas Jefferson and John Adams was highly contentious. Jefferson and his running mate Aaron Burr tied in the electoral vote, leading to a decision by the House of Representatives. The election of 1824 saw Andrew Jackson win the popular vote, but loses the presidency to John Quincy Adams after the decision went to the House of Representatives, leading to accusations of a corrupt bargain. The election of 1876 between Rutherford Hayes and Samuel Tilden was marked by widespread voter intimidation, allegations of fraud, leading to a compromise that resolved in disputed results. And fairly recently, the election of 2000 between George W. Bush and Al Gore was decided by the Supreme Court after a contentious recount in Florida. So need we say more between former President Trump and President Biden in the previous election? So we shouldn't always think what's happening in our day and age is always unique. That if you dig into history a little bit, you find that things tend to repeat themselves, just in a little bit different form and maybe a different audience. So there is some good news. While the election may feel different, and they all do at some point, it's hard to find evidence that politics is really a long-term detriment of market performance. This has been true over the long term as well over the past 8 years. And we'll discuss 4 lessons that we can draw on from history. And please keep in mind, while the presidential race is a major highlight reel, there's really a lot more to the backstory. So in this year's election, we actually have 468 seats in the U.S. Congress up for election. The House has all 435 seats up, and the Senate has 33 seats. And right now, the current makeup of our Congress in the House is the Republicans have approximately 219 members, and the Democrats have 212 members with 4 vacancies. The Senate has Republicans leading by a little bit, 49 members, Democrats 47, and there are 4 independent members. So to keep that in mind, I also want to create other context. The U.S. House of Representatives has 20 standing committees, and these committees handle various legislative responsibilities, including the consideration of bills, oversight of federal agencies and programs. So these committees all play a crucial role in shaping legislation and overseeing various aspects of government operation. In the U.S. Senate, there are 16 standing committees, and these are essential for managing the Senate's legislative workload, including the review of developmental bills, oversight of federal agencies, and other key functions. And this does include the many ad hoc committees that are formed. So it's not to say that the presidency is not important, as it is the face of our country, and is leading to try to provide direction. But there's often a lot of work that is behind the scenes that are being done by other elected officials that really do influence and make a difference of what happens in the laws that are being passed. So I create that context because I wanted to make sure you understand that not everything is going to go through the presidency. So with that, we're going to go to our first slide and our first lesson. Fundamental conditions drive market performance. So I'm a big movie buff, and as Jerry Maguire said, with it was a Tom Cruise and Renee Zellweger movie. It was a rom-com back about 15, 20 years ago. It's about show me the money. And businesses need to make money for people to invest in them, and that's really what matters. So while headlines and investor sentiment, both individuals and institutions, may influence short-term market movements, fundamentals guide long-term performance. Factors such as inflation, the economy, the Federal Reserve policy really do exert more substantial influence on performance than the election cycles. Unfortunately, this is a lesson investors have to relearn every 4 years. So keep in mind, over the years, markets are up about 75% of the time versus down. So right now, the US is about a $28 trillion economy driven by consumer spending. It isn't re-engineered because the election results. And instead, interest rate conditions, financial imbalances, and outside shocks can really produce downside surprises. So over the last 40 years, there's only been one instance when the market returns were negative 12 months after the election. It doesn't seem, it's over 20 years ago, but it doesn't seem that long because I was working at that time. There was during the tech bubble burst in 2000, as the following table shows, even though stocks were down significantly for 3 months after that, the markets ended up producing gains 1 year later. And in both 2000 and 2008, market declines can be attributed to outside macro factors or financial imbalances, like the bad batch of loan derivatives in 2008 rather than politics. Also evident in the table, you'll see, excuse me, that the market's initial reaction to election outcomes are often misleading. In 6 of the 10 elections, stocks declined the day after the election, but the drop was quickly reversed. And this is not to downplay the importance of the US presidency or the gravity of the election, but the key takeaways is that the economy does not change course based on electoral results. We need to look at where the economy is today, what factors can influence the trajectory of the markets over the next 6 to 12 months. So our second lesson is that markets don't favor a party. I know we like to think that, and especially people that tend to be hardcore blue or hardcore red. But despite the temptation to tie market outcomes to election results, stocks have performed well under both Republican and Democratic presidencies. The strongest returns historically occurred during the Roosevelt tenure and the Clinton tenure for the Democrats, and for the Republicans, it was under Eisenhower and Reagan's presidencies. So if you go back to 1930, there have been 23 US presidential elections, with the Democratic candidates winning 13 times and the Republicans prevailing in the remaining 10. And when you look out from each of those presidencies with really a more meaningful horizon of about 10 years, post-election, both parties are similar, with the S&P returning around 7%. So this same pattern is observed over the last 2 presidencies. And despite the huge chasm between President Joe Biden and former President Donald Trump's policies, both experienced equity bear markets, one caused for Trump during the pandemic, and the other by the aggressive Fed tightening policy during President Biden's presidency. And stock prices, when you look back, the stock market returns really have been identical. The S&P 500 has returned 14% after dividends under each presidency, highlighting that the markets are neither biased towards one party nor exclusively driven by the election outcomes. Really, what markets are looking for is clarity and consistency in the governing body's policies, no matter what they are, and within reason. But because of our government system of checks and balances, we rarely have extreme policy. So that's why we have the consistencies that we do in the markets, regardless if it's a Democratic president or a Republican president. Lesson number 3. Repositioning your portfolio based on potential policy changes can be very, very risky for investors. Really, macro forces are more powerful drivers than politics, even at the industrial level. So one example, and this slide is one really interesting snippet. While the economy and broader equity markets are harder to influence, certain sectors such as healthcare, traditional energy, clean energy, aerospace, defense tend to be more sensitive to likelihood of a particular candidate winning the election, especially if that candidate is focusing in on a particular industry. But you don't have to go back many years to find the winners and losers from an industry perspective, which are really guided more by, again, macro forces. So going back to when Trump was president, he was much more favoring traditional energy sources such as oil, natural gas, coal, to slowly transition to cleaner energy, while President Biden was supporting a transition to renewable energy on a much quicker note based on climate change. And the instinctive choice from an investor standpoint, based on the positions of the candidate, was to overweight the traditional energy sector, after the 2016 election and the renewables after the 2020 election. However, that strategy would have yielded very, very poor results. So during the Trump presidency, clean energy actually outperformed traditional energy by 43% that year. And during the Biden administration, traditional energy outperformed clean energy by 53% per year. So along with these views on energy policy, the key election issues are at stake this year from an investor standpoint are taxes, tariffs, and immigration. The Trump is really looking for more deregulation, lower taxes, which could possibly aid economic growth, but an aggressive approach to tariffs and immigration could be inflationary and lead to higher interest rates, because part of normal and regulated immigration creates people for the labor markets. And if you start to dry up the labor force, you're going to drive up labor costs. So that's where possibly the inflationary impact. And tariffs, while might be effective short term, eventually long-term tariffs eventually do get passed on to consumers. And on the Democrat side, we really don't see candidate Kamala Harris changing policies based on what the current administration policies are on trade and taxes. I think she's going to fall step in step with current President Biden. So again, regardless of which candidate wins the presidency, we think there's a high chance Congress will remain divided and thus provide gridlock that will likely continue. And while this will be difficult to pass any major new legislation or reform, the system of checks and balances remain intact. And what markets welcome is, with political gridlock, means that there's more transparent operating environment for companies with less policy upheaval. Again, markets want clarity and consistency. The unknowns tend to drive markets from a volatility standpoint up and down. A key thing I want to comment on, though, is and neither candidate or party for that matter tackles our increase in national debt. So I just felt from an education standpoint, it'd be good to go down this path, because there are current implications and long-term implications. Right now, our national debt is approaching 37 trillion. And if you ever go to downtown Cleveland, you see the big billboard on the left-hand side, telling you the total amount of national debt and how much each person has to contribute to pay it off. And to put it in perspective, and one of my favorite things to put it in perspective is a time comparison. If you take 1 million seconds, that's about 11.5 days. 1 billion seconds is about 32 years. And if you take 1 trillion seconds, it's about 32,000 years. So to put this in perspective, if you take 37 trillion, it's equivalent to about 1.18 million years. So I think what gets lost is when you use the number 37, that doesn't sound a lot, and people have a tough time envisioning what $1 trillion really is. But it really does matter. And if I asked each of you how to run your household, I really do think many of you are trying to create a balanced checkbook. And unfortunately, our government has lost sight of that. And what ends up happening is there's repercussions that will come later. And I think that's what everyone's thinking. They're kicking the can down the road. But there are impacts today. So right now, our government is spending, it's projected this year to spend $1.158 trillion on just debt service. That represents about 4.2% of our current budget. And why does that matter? That money, which is going to do debt servicing, is allocated to that part of the budget, and now can't be allocated elsewhere. So now you have what I call crowding out of other spending. This can reduce funds available for other important areas such as defense, education, infrastructure, and other social programs. Fiscal restraints. This could lead to difficult and budgetary decisions, potentially leading to cuts of essential services. I mean, how many times do we see during each presidential tenure that the government's going to shut down because we need to expand the budget? Increase borrowing costs. You know, think about it this way: when you're saving, they always tell you that the interest rate or compound effect of interest is like the eighth wonder of the world. Well, that's in saving. It also works the same when you start accumulating debt. When you start getting debt and it starts compounding, you'll spiral down or corkscrew down the economy, and that's something where it could eventually happen. And again, the economic impact, high levels of debt and debt servicing can really affect the overall economy by reducing public investment in critical areas that support economic growth. So this is an issue I think both candidates, do not care to talk about. Neither party. They tend to point the finger at each other, but at the end of the day, there's going to be some reckoning, and we need to deal with that because it'll eventually it'll reach a tipping point, and it's something that we need to deal with. And while both parties claim their policies will impact the economy positively, common sense dictates right now we really do need to cut spending, and we do need to create income taxes. And that's something both candidates really don't want to talk about. But when you think about 41% of the Americans pay no income tax, and I'm not including Social Security because I don't believe Social Security is really a tax. It really should be renamed Social Security contribution. So this is just a broad picture of what we're dealing with at a macro level, and it's something that we need to deal with. And in closing on that one topic, the U.S. federal government, their debt is approximately 120% of the GDP. We are ranked as a country 16th highest out of 164 countries. And so that's kind of where we're at. And while we have the largest economy, if you look at our national debt, it is more than the next four countries combined, which includes China, Japan, France, and Italy. So again, I'm trying to just create context of something that really is potentially be a black swan. And I'm not trying to paint doom and gloom. I think as a country, we always figure our way out because we used to have a balanced budget. I think things need to change within Congress to figure that out. But hopefully it'll be sooner than later. Next slide I want to talk about, and it's my last slide, it will be volatility. Okay, around election, again, there's lack of clarity, who's going to win. Both candidates are talking about their policies and are also pointing out at each other what could be wrong with each other's policies. And while that could be the case, fundamental conditions, again, predominantly determine market performance. And while elections do influence short-term volatility, we all have anxiety, we all have uncertainty as to what this president's going to do, what is Congress going to do. At the end of the day, volatility will usually rise around elections and post-elections, but after we get past that point, the performance of the markets tend to fall in line. And it's really economic factors, macro factors that will determine whether we continue, with this soft landing that we had in the economy so far, and will this lead to a next bull market run, or will we get into a light recession or recession? And so I'm going to turn it over at this point and have Chelsea really touch on the economy and what we might be looking forward to over the next 6 to 12 months.
Thanks, Frank. I'm ever a note taker, especially with your lessons, and a key quote that I got that I'm going to continue to share with the rest of our clients is: the economy does not change course based on election outcomes. Now, that's not to erase what you shared about the impact of a president and Congress, what those policies could do for the economy, but the immediate results of an election won't completely reverse the course the economy is on. So we're going to dig into a couple of key indicators of the economy here. We're going to first look at this this heat map. This is global economic activity momentum. This allows investors to get a timely and clear picture of economic growth across both developed and emerging markets. It's timely in that we're looking at measuring this by the quarter. And we've got about 15 years of data here. This is based on the S&P Global Market Composite Purchasing Managers Index. So this includes both manufacturing and services activity, and it's a real complete picture globally of economic momentum. With this being a heat map, green means accelerating, green is good, and red indicates that momentum is decelerating. Now you can see this is not only broken into some different sectors, it lists out both of our developed and emerging markets, and then the aggregates of those developed and emerging markets. As we look at some of this historical context, you can see how the global economy saw an uneven and long recovery right around the global financial crisis. You see 2008 and 9 there, a big stripe of red. That's where you can see was, again, a bit uneven and took a long time to recover from that. And then, of course, in 2020, we see how the response to COVID-19 that led to a very sharp contraction in economic activity around the world with that deep red color there. There was no country or region really immune to this mini recession that was caused by those pandemic restrictions. On a positive note, though, the color did start improving around the third quarter of 2020. So you can see it kind of moving up there. And then, there were a few fits and starts through those COVID reopening waves. And by early 2022, those readings became much more uniformly green. You can see, though, going past that, everything turned a little bit yellow and orange again, and which showed that huge loss of momentum, which went through 2022 and then carried into 2023. And this is really a consequence of elevated inflation and tightened economic conditions. So that each of the Federal Reserves, the central banks around the world, making some of those economic tightening policies and carrying those out, as well as those higher energy prices that were affecting Europe, and then the zero COVID policies that had affected China. Now, after a sluggish ending to 2023, the prospects for the global economy at large appear to be turning a corner here in 2024. So far, it's been mostly green around the world, suggesting that there's a decent amount of momentum and a relatively low probability of a global recession in the near term. So key takeaway here, good momentum, low recession indicators from a global scale. Getting a little bit further into GDP, now we have two charts here. I'm going to look first at the chart on the left. This is real GDP, one of the biggest factor of the U.S. economy. For those of you who might not be familiar with the terminology, real GDP versus nominal GDP, this means GDP but accounting for inflation, which I think is very key. We certainly have plenty of years, prior to recent years of very low inflation, but it's important to take into account the high inflation we had in recent years as we look at this. And you can see that not only has the U.S. economy continued to grow each year, but it's averaged at about a 2% growth rate. You can see that that big contraction there, of course, in 2020, and even the contraction back in 2008 and 9, that global financial crisis. You can see it took a bit longer for us to recover from that. The pandemic really created a much sharper decline, but we also saw a faster recovery. So going back to today, overall, the economy has really surprised us in terms of its strength and durability in light of all of this monetary tightening, with recent GDP growth trending just a little bit above that 2%. So the economy is still looking relatively healthy. And again, this is GDP adjusted for inflation. Moving to the right side of the graph, these are the components of GDP. This is nominal, so this is not taking inflation into account. But you can see, to Frank's point earlier, 17% of our GDP being a portion of government spending is pretty big. But let's take a look at the largest factor, being consumer spending. On the next slide, we'll dig a little bit more into that, but first, let's just talk about each of these components here. So of course, consumer spending, nearly 70% of our economy, but government spending, business investment, residential investment, and then out net trade balance. A big part of our resiliency has been due to the U.S. consumer. We're still continuing to see some strong growth there. Companies are continuing to invest with that about 14% in investment, excluding housing. And then with the housing market, even though mortgage rates have risen quite a bit and have put some pressure on our housing system, it still contributes less than 5% to the overall economy, which really reduced its impact. And then, of course, these continued capital expenditures in technology, in AI. I just read this morning that I think it was Google. They're looking into nuclear energy to help support some of their data centers to power the electricity for these for AI and these other technologies. There's continued business investment, which again all indicates a relatively healthy economy. So we're still seeing some indications of strength among these different factors here. Let's move into the next slide, though, just to peek a little bit further at that, at how our consumer is doing. So looking at the health of the consumer, we're going to begin on the left side. Consumer balance sheets held up remarkably well during the pandemic, of course, due to lots of fiscal support, people staying home and lowering their spending and things like that. But even as the economy is normalized, balance sheets are still looking in pretty good shape, which really supports the tight labor market that we've had and rising real wages. On the top right, we look at the household debt service ratio. So this is the percent of after-tax income that's being used to make payments on mortgages and other types of consumer debt. This declined to a 40-year low during the pandemic. It's rebounded a little bit. A big part of this is that aggressive Fed tightening policy. So remember, the Fed's intention to tamp down inflation was to slow down the economy. One of the ways to slow that down, make borrowing a little bit more expensive. And which then impacts spending and everything else. And so that tightening has really fed through to higher housing borrowing costs, and it has contributed to a rise, but compared to history, it's still pretty manageable. The only cracks that we're going to really continue to monitor, I wouldn't call it concerning yet, but things to just keep at in the forefront of our minds, is that there is a little bit of a wind down in consumer saving and this higher cost of living, which of course was the result of inflation. And this has led to higher credit card balances and delinquencies. And that's what this chart on the bottom right is showing. So after remaining mostly flat for the better part of a decade, we're starting to see early delinquencies increase. So it's, like I said, it's nothing super concerning yet, but it's something we want to keep track of to see how the consumer is really holding up as the Fed continues to slow down the economy a bit. Let's move next into the labor market and take a look at how the average worker is doing and some of those pressures and how they impact the economy. The first piece we're going to look at here is unemployment and wages. This shows the unemployment rate and wage growth since the 1960s, and these have had an inverse relationship historically. Now we can see not only leading up to the pandemic, but that red hot labor market and that huge spike in unemployment at the onset of the pandemic. Since then, we saw that drop back down to a multi-year low, right around like that. You see sort of that around 2021 to 2022, that low of 3.4. We're starting to see a little bit of normalizing. We're off the lows, so we've moved a little bit away from that low of the 3.4%, but we're oscillating around still a relatively historical low of around 4. So unemployment claims haven't really picked up meaningfully yet, job openings still remain elevated. So to put it in a little bit of context, the unemployment rate averaged 5.4% between 1990 and 2007, the eve of the global financial crisis. And the natural unemployment rate today likely sits, with more recent data, right around like that 4.5% to 5% range. So overall, what this indicates to us is the labor market has regained a little bit of its balance. It doesn't seem to be operating in any extremes right now. We're also looking here at wage growth. This is a particular focus for the Fed because of how wage growth impacts inflation. It was very strong during that initial economic expansion, the reopening post-COVID, and it reached levels really not seen since the 1980s. And this was most acute. We were most aware of this in lower wage sectors, actually, like leisure and hospitality. A lot of that pent-up demand for some of those services, once that was unleashed after the pandemic, we had these businesses who were facing this new surge of demand, but they had difficulties luring new workers. We also, in other sectors like healthcare and professional services, businesses have also struggled to find some of the right kinds of candidates, and as a result, they need to offer higher wages to attract those people. The labor market tightness, though, which means more labor than there are jobs, it's eased a little bit, and some of these slowing economic conditions have limited some of the bargaining power of workers they previously enjoyed in even just the last couple years. I do want to point out, because it had been in the headlines quite recently. We've seen lots of information or lots of headlines out there about striking union members, the dock workers, and even like with the auto union. But it's important to note that about only 12% of the workforce is actually represented by a union, which is down quite a bit from where it was in the 80s, which was around 20+%. So while we see some of those headlines, and those certainly can make impacts economically and on a supply chain side, we do think that the overall size of those types of jobs has a slightly smaller impact on the labor market as a whole. And we think that's going to lead to, again, continued normalization in the labor market, maintaining a relatively low unemployment rate, and just a deceleration here of wage growth, which would, for the Fed, be really a welcome combination. Again, their goal with the soft landing, which I know you're all probably tired of hearing that phrase by now, but the soft landing is to slow down the economy without skidding us to a halt where we see high unemployment or stalled out growth. And so that's kind of what we're aiming for. Speaking on both facets of the labor economy with their supply and demand, the labor market still continues to be a pretty bright spot, with labor demand rising exceptionally during this expansion. Again, businesses are still grappling with that pent-up service demand from the pandemic. That's eased a little bit, but it's still something that they've had to contend with. So we're going to look at a few different indicators here on this page of the JOLTS report being one, which is job openings and labor turnover. And so we're going to begin here looking at the left. So you can see the record number of job holdings, which are measured on their 3-month rolling average. These reached record highs in March of 2022. These are quickly declining, but by historical standards, they're still elevated. And what we like about this report is that it gives a layer of protection for the economy, because even if there is a bit of a recession that begins to bring the demand for labor down from businesses, there's still a buffer before we start to see this relationship between labor demand and supply really begin to get constrained and causing increased unemployment. So there's still enough of a buffer there where, again, this could be absorbed if we start to move into recession territory. On the right, I think a really good maybe even softer indicator of the health of the labor market is the quits level, which again, we think it really illustrates not only labor market tightness, but those wage pressures. People quit their jobs when they feel like they can very easily move to the next job and they can earn similar or better pay. And when there's far more jobs than there are people, you've got a good amount of bargaining power. Now, of course, we see that there was a high demand for this, or a record high for this last year. Again, that hot labor market really encouraged people to seek employment elsewhere or different opportunities. That is starting to normalize a little bit, really just back to those pre-pandemic levels. Companies have also been trying to maintain their existing workers in light of labor shortages with layoffs, and this is on the bottom right here. They're remaining pretty low by historical standards as well. It's been rising towards its long-term average, but it might be a good thing, again, suggesting that the labor market will shift a bit more back into balance, and again, similar to its longer-term trends. All right, the last item that I want to go over with you is labor supply. Job creation has remained really quite strong, and this is really partially explained by gains in the labor supply. We're showing the pace of job gains here, which is illustrated by growth in non-farm payrolls, and its 3-month moving average. It's, of course, normalized quite a bit from that post-pandemic boom in 2021 and 2022, but it's still elevated, with anywhere from 200 to 300,000 jobs being added each month. For an economy that's been on recession watch lists, employers are still adding jobs and closing that gap of excess demand for that labor at a pretty strong pace. A big reason for this is shown on the right side, and we'll take a look at the upper right chart there. Growth in the US labor supply. We're showing year-over-year changes in the labor force. We saw a sharp drawdown during the pandemic, but there's been a very solid recovery. Part of this has been due to very strong immigration. A recent statistic actually is the immigration agency data that shows approved applications for immigrant work has reached 2 million in 2023. That's up over 70% from 1.2 million in 2022. So we do have a strong force of immigrant labor coming in, getting approved for jobs at a pretty high rate, and thus able to contribute to the economy, which has been a really powerful boost to that job creation, and likely explains how the economy has maintained that strong job growth without heating up wage inflation too much. And then on the demographic side, with this lower right-hand chart, labor force participation, we've also had a very strong recovery there. It's still below pandemic levels with the working age participation rate for those aged anywhere from 18 to 64, but it's recovered a little bit. Of course, we saw for a lot of our clients actually, but a lot of people who were pretty close to retirement or approaching retirement when the pandemic hit, that became a prime opportunity for a lot of people to take a second look at their careers. And there were a number of people that either for personal reasons, for childcare or whatever, they decided to make the change to leave, and the decision to leave the labor force. People either opting for early retirement, women who had enjoyed staying home with their kids, or had been staying home with their kids during the pandemic and decided to either leave, stay out of the workforce a little bit longer, or take a little bit more time getting back in as they work to balance out their family schedules. So some of those pressures remained, which again tightened everything quite a bit, but we're beginning to see a recovery there. And I think this is helpful because when you look at a lot of our country's demographics, we still have some future concerns about our population growth, with people simply having fewer children or waiting until later to have children. And so some of this gap, this demand that's being created here is able to be filled in by the supply through both immigration and, again, a return to the workforce for some of those people who are below retirement age. We'll move to Cynthia next, who will begin to take some of this data and further economic data and talk about some of the not only implications for the overall portfolio, but the things that we'll be keeping an eye on as we move into the next quarter.
Oh, thank you, Chelsea. Good morning, everyone. Now, let's take a look at the inflation and the federal monetary policy. Both are still remain under the spotlight. On inflation, this slide takes a look at the building blocks for the annual headline inflation over the past few years. As you can see, inflation began rapidly increasing in 2021 through 2022 with broad-based drivers across energy, which are the green on the chart, core goods, which are the orange, and services, which are the light blue on this chart. Since peaking in June of 2022, inflation has been gradually coming down with significant progress made in energy, new and used vehicle, and food prices. The progress towards the Fed 2% target has been very meaningful in 2023 when we closed the year with close to 3.4% inflation, but that trend got pretty much stalled in the first half of 2024, with headline CPI has been range bound between 3.1 and 3.5 between January and June. And that kind of explained that even though with the expectation that the market were expecting Fed gonna cut rate in March, it didn't happen because the data are just not being there to support Fed to see that, okay, now we are confident that to bring the inflation under control. Now, CPI does resume a downward trend in the third quarter and finish August with 2.5 and September at 2.4 year over year. That has been the lowest CPI rating since February of 2021. While the journey back to the 2% may take longer than expected, there are still some disinflationary forces that could allow inflation to resume its downward path in the back half of the year. Couple things that we're looking at: core good prices have continued to trend lower in 2024 as supply chains have remained very well managed. On the more volatile component, energy prices have rebounded in recent months due to higher gasoline prices, while the food inflation has remained very mild. Moving forward, the slow global demand could potentially limit the likelihood of a surge in either of those categories. And that brings us to the more stickier component of the inflation, which is shelter. Shelter inflation accounts for over 1/3 of the CPI basket and has been held very stubborn above its pre-pandemic level. In fact, that measure has grown by 0.4% or more month over month for 7 consecutive months. And given that the CPI rent growth is more of a lagging indicator, and market rent growth, which is reported, that was reported by Zillow, is now below the pre-pandemic level. So it gives us evidence to believe that shelter inflation is expected to align with real-time metrics as the market rent return back to normal. Overall, inflation should continue to ease through the balance of 2024 and into 2025. While the write-down may take longer than we anticipated, the Fed should feel more confident that inflation could fall close to their 2% target and without any further policy tightening. And this is really what Fed has been done in September. Last month, Fed decided to cut its benchmark interest rate for the first time from its 23-year high by an unusual large 0.5%. That helped bring the policy rate down to 4.75% to 5%. And one more thing worth noting on this chart is Besides that 0.5% rate cut, Fed members also revised their third quarter Fed rate expectation materially comparing to their expectation that they posted in June. To be specific, the Federal Open Market Committee rate expectation for year end of 2024 fell from 5.1% in their June survey to 4.4% in their September survey. Also, their 2025 year-end rate expectation has dropped from 4.1% to 3.4%. This dramatic change indicating that we will have likely another 0.5% rate cut till the end of this year, 1% rate cut in 2025, and another additional 0.5% rate cut in 2026, which eventually gonna help bring the current, what we consider a more restrictive policy rate, back to a neutral rate of 3% in about 20 months. In our view, this revised expectation suggests that Fed are happy about the job they have done in the last 2 years and feeling confident that they put inflation under control. Now they're shifting their priority regarding their dual mandate from fighting with inflation to help maintain a full employment. The actual path of the rate cut, will be more determined by the upcoming economic data, and it may not follow exactly the scenario as we discussed today. In September, the U.S. added about 254,000 non-farm payroll jobs, which is almost double what the market expected, 140,000 jobs created. The core inflation also came in slightly higher than expected, which may lead Fed to reconsider their rate cut plan towards the end of the year. So at this point, market are expecting maybe 1 rate cut instead of 2. Although the trajectory towards reaching that neutral rate still remains uncertain, the overall shift towards a more easing monetary policy is likely to support the economy in general for the soft landing expectation. Also, it's going to help continue to support the stock market rally and the bond market recovery. Now let's shift gear a little bit, talk about what does this all mean for your portfolio and where are the opportunities are and how you should consider position your portfolio accordingly. Market overall has been very resilient since our 2022 drawdown. S&P 500 has closed at a record high 43 times so far in 2024. Stock market highs can feel like a mixed blessing, especially for those still holding cash on the sideline and waiting for a better investment opportunity. When stock reach record highs, investor may conclude that, okay, well, the market has already peaked its all-time high and I've missed the boat. However, a closer look at history shows that's not really the case. Over the long period, market have trended higher and peaked multiple times in past cycles. This chart shows S&P 500 index have reached 1,432 new all-time highs since 1950. It also shows how close the all new time highs cluttered together. In 1995, for example, S&P closed at a record high 77 times. In fact, investing when the S&P hit a new all-time high has historically led to a more stronger return and a stronger performance than investing on days when it doesn't hit a new all-time high. Since 1970, in the 12 months following a new all-time high, the S&P 500 has produced an average return of 9.4%, and in the following 24 months, it returned about 20.2% on average. That including investing at the very peak of the market before before a new bear market. By comparison, investing in any other time resulted in average return of 9% and 18.5% for the 12 months and 24 months period, respectively. Overall, this seems like productivity and innovation that are just very incredibly powerful forces that can continue to push the economic growth. We're going to have downturns. There is no doubt about it. It's kind of inevitable. On average, the S&P 500 have experienced about 3 separate 5% pullbacks and 1 10% correction per year since 1950. Well, the corporate earnings growth right now still remains solid. That kind of justifies the stock valuation at the current level. We won't be surprised to see that if stock market catches breath with a 5% pullback or even a 10% correction adjustment in the next couple of months. But that doesn't change the long-term trajectory. So it is still not too late to get on the boat if you have a long-term investment horizon. For those who already invest in the market, it is perfectly fine to take some gains off the table, rebalance your portfolio towards your long-term target allocation. Just try to avoid shifting your strategy around with short-term concerns, as studies have supported that staying disciplined with your long-term investment plans is often more beneficial than trying to timing the market. Well, naturally, the follow-up question would be, what should I invest and where are the opportunities still are on the market? Now, this slide helps us dive deeper into the S&P 500 index concentration and analyze the Magnificent Seven stocks. It's a popular name given to a group of high-performing tech companies that has been dominating the market performance in recent years. On the left, we break up the performance of the Mag 7 and the rest of the index. As we show in this table, the Mag 7 accounted for 63% of the return in 2023, driving a stellar 24% market return for that year. However, it's also the same 7 stocks that drive the market lower, accounted for 56% of the severe sell-off in 2022. So far this year, those companies have continued to outperform, bring the market to new all-time highs. So what has been really accounted for all those performance in those tech companies? Well, a big part of that is shown on the top right of this page, where we take a look at the annual earning growth for the Mag 7 versus the rest of the index. After contracting in 2022, Mag 7 earnings grew by a very strong 31% in 2023, where the rest of the index experienced an earning recession. Now, looking at 2024, Mag 7 earnings are still expected to be similarly strong, but this time growth is broadening out, which help explain the broadening out the market return that we have enjoyed so far. Mag 7 this year accounted for 44% of the year-to-date return. Even though they're still the main contributor to the performance, they no longer dominate the market return this year. Another thing that we want to highlight on this page is a very important feature about the Mag 7 is that this group is not a monolith. On the bottom right, we show the performance dispersion within the Mag 7, which is quite wide this year. Year to date, you have one company that is down 2 digits, and you have another company that is up over 100%. Market performance can change a great deal among those names. The large performance dispersion and the broadening out earning growth both suggest that there are opportunity to be active, to be selective, than purely investing in the index. 7 stocks or the US market are not really the only place that we can seek solid investment opportunity. Outside of the US, there are a growing list of rivals. For example, Europe, they have a less concentrated equity market that offer a wider breadth of companies that are top contribution to the FSCI EFA index. It is index that measuring the performance of developed market stocks. In fact, the 7 leading contributors to the FSCI EFA index has outpaced their US-based cohort since the beginning of 2022, rising more than 60%. We really do have a market that are expanded beyond the Mag 7, not only in the US, but globally as well. In addition, as Fed cut rate, US dollar are expected to weakening, which create great tailwind for international and emerging market stocks. Now, lastly, let's take a look at the bond market. Here, we show the 10-year range for yield across several fixed income sectors and noted the median over the last decade as well as the current yield level. Current yield are still sitting at some of the most attractive levels since we have been seeing in recent histories. Given the very tight relationship between current yield and subsequent performance, bond investors can expect very decent returns from the income or coupon those assets generate over the next few years. Moreover, at current level, bond can provide more of a buffer in market correction or if there is an economic downturn. So for those who are concerned about short-term market volatility, it may be worth considering stepping back into the bond market a little bit, but just to be mindful, don't extend your duration too much at this point, because the path to the target 2% inflation is not going to be a linear trend. We're probably going to see some reverse trend down the road and some sideways down the road that could potentially introduce volatility in your bond market. So extending the duration too much at this point may introduce too much of the interest risk to your portfolio. Okay, so here are the few takeaways from today's discussion. Number one, stock performance, it is more driven by the economic and the business fundamentals than the potential policy change or election outcomes. When make decisions about shifting strategy or adjusting your investment allocation solely based on the bet of the election outcome are not likely to provide you the return you're looking for. Number two, we do not expect a recession in the near horizon. Economic indicators still suggesting we are on the soft landing trajectory. Number three, softening labor market and decelerating wage growth have helped to take the pressure off from the inflation. We do expect that the inflation will head it to the 2% down the road. Maybe the journey is not as quickly as we expected, but we do have the confidence it's going to head there. Number four, market has expanded really beyond the Mag 7 within and outside the US. And when it comes to stock investment, make sure to remain selective and remain active. When it comes to the bond market, overall, the bond market are still very attractive across many asset classes. Try to focus on more high quality, intermediate term, if you have concerns about the market volatility or the market downturn in the near term. Well, that's conclude our presentation today. I guess we have about a minute to address any questions we may have.
We could stay on a few more minutes if people
Okay.
have some questions. So there's a Q&A if people would like to type in their question and direct it at all of us or direct it myself or Cynthia or Chelsea. So you should see a little Q&A box at the bottom of your screen. And we must have good listeners, and they totally understand everything we laid out.
We
Well,
will be sending out the slide deck too.
yeah, so for those that if we've gone a little too fast or there's some things that are a little technical, obviously you can call us. But we will be sending out the recording and the slide deck of the presentation today. So if other questions pop up later on, again, feel free to call us at 440-740-0130, or you can email us at our general mailbox, and depending who you have the question for, we will route the question to either myself or Cynthia or Chelsea. And we usually respond pretty quickly, but please give us at least 24 hours because we all have meetings throughout the day taking care of our clients. But yeah, I don't see any questions. I'll give it another 30 seconds, and if there's no any other questions, we will thank everybody for attending, listening, and hopefully they received a lot of good information. I guess the big takeaway I'd like to make sure everyone has is, the elections will pass, and we will get back to normalcy, and then all those commercials that we would like to be able to mute out or get out will cease for at least a couple more years till the midterm elections kick back in. So I don't see any other questions. With that, on behalf of Cynthia, Chelsea, and myself and the team here at Return on Life Wealth Partners, we want to thank you for listening. Hopefully you have some great takeaways. Please share your takeaways with others. If they have questions, we welcome an introduction to help other families with their wealth management needs. So with that, take care. Go Guardians. For those that are Cleveland fans, we got a big home stand here that we need to take down those, as they say, damn Yankees. So take care, everyone, and thank you.